All right, so I want to talk about what's happening in the markets right now because if you have a lot of money invested in things like gold or silver, could be tech, S&P 500, NASDAQ, crypto, or if you own real estate, there's a lot that's been going on and a lot of headlines circulating. Are we heading into a recession? Are we at a local top? Are we getting ready to have a bubble bursting? And so a lot of people are confused. For instance, like gold hit a top a little bit ago. It took a little bit of a dip and has been stagnant since. Tech has been similar. Some tech stocks are still doing pretty decent and at all-time highs, but a lot of tech is very choppy, up and down, trading sideways. Crypto is very similar, but as of recent, there's been a pretty big drop, anywhere between 10 to 40% over the last few days and a few weeks. And so it's been pretty terrifying in that instance. Real estate also, if you own real estate or you're trying to sell your home, you know that real estate has been very lackluster for quite some time now. And so I'm going to explain what's happening and what we can most likely anticipate that has the highest probability. So to really understand all this, you have to zoom out. And you have to understand that every single asset that you own, gold, silver, S&P 500, NASDAQ, real estate, any tech, crypto, single stocks, everything is controlled by one force now. And it's the force that controls all directionality of assets, and that is total global liquidity. This single lever is what moves markets and contracts markets. And once you understand this picture and how this all ties in together, and also the timing of each asset class, because every single asset is now tied to this, but they all lead and lag. In other words, they all move at different time periods. Once you understand this, all of this will start to make sense and hopefully start to ease your mind about what to expect in the future. So let's just really quickly, first, before I dive into each of these sectors and tell you where we're headed, you need to understand what total global liquidity is. Global liquidity is basically just all the money, entire money that is circulating in the system. It includes things like central banks, commercial banks, money markets, all of it. And it really is the oxygen and driving force or the fuel that drives the financial world. The easiest way to understand it is this. When liquidity expands, asset prices go up. When liquidity contracts, asset prices go down. It's literally that simple. Let's talk about where we're at right now in liquidity. I'm going to pull up a chart. So this right here is a chart of the total liquidity index. So in other words, it's showing you the movement of all liquidity, and it starts back in 2008. And there's a reason for that. The entire global financial system completely changed in 2008. I'm not going to go into a lot of details on that because I could talk forever on that. But what you see here is a logarithmic band showing the expansions and contractions of liquidity since 2008 up until today. This red line, if you can see it in the middle, is the average mean growth expansion. And then you have two standard deviations above, two standard deviations below. Okay, so as you've seen, it's gone up, it's gone down, it's gone up, gone down. Currently, where we are sitting is near the bottom of the logarithmic bands, meaning that we are probably towards the end of the liquidity squeeze, and highest probability moving forward is going to be going back up towards mean, potentially even overshooting over time. Now, another way in which we know that liquidity is going to need to expand is when we look at the interest payments that are needing to be paid. So probably one of these single biggest factors that helps us know that liquidity needs to expand is the fact that over the next 12 months, we have about $10 trillion that the government needs to refinance. And when you look at a chart like this that shows the federal government expenditures, so in other words, interest payments that we're paying, those lead by about 36 months. Okay, this red line right here. Easy way to explain it is that the interest payments or the debt payments that the government needs to do creates the environment or the condition that eventually makes liquidity need to increase to match. So as you see, the red line will go first, and then your black line, which is the liquidity, will follow. So in other words, in order to pay back the debts, the $10 trillion that we need to repay back coming soon in the next up to 12 months, we have to have more money into the markets, and rates need to be more favorable in order to do that. So that's another indicator that very strong likelihood, high probability that liquidity will continue to rise, will need to rise. In addition, rates will probably need to be lowered because usually when you refinance your debts, rates need to be lowered to create more favorable terms and make it easier to pay back those debts. And those two factors of increasing liquidity and lowering of rates are extremely bullish on asset prices going up. Now, let's talk about how correlated these things really are. So how do we know just because liquidity goes up that asset prices go up? So this is a chart right here that shows how highly correlated something like the S&P is to total global liquidity. And in fact, it's about 98% correlated, meaning that 98% of the price action that you see in the S&P 500 is tied directly to total global liquidity. As liquidity goes up, S&P goes up. As liquidity goes down, S&P goes down. Extremely strongly correlated. But it's not just the S&P. The NASDAQ is the same way. Let's look at that. NASDAQ is roughly 95, 97% correlated, meaning that at least 95 to 97% of the entire price action of NASDAQ, so going up and going down, is tied to total global liquidity. So once again, very strong correlated. In fact, all asset classes are extremely tied to total global liquidity. Everything follows liquidity, just at different rates. So now that we see that we have $10 trillion of debt that needs to be repaid in the next 12 months, and you cannot pay off old debts at high interest rates without injecting more money into the system and lowering some rates, which both are extremely favorable for assets to go up, which we've seen the correlation. When liquidity goes up, asset prices go up. So now that we know that, and it's not just opinion, it's literally math and things that need to be done. Otherwise, we head into credit default, we don't pay off our debts, and we have pretty massive challenges moving forward if we do not do this. The next thing is understanding which assets move first and in what sequence, because every asset's going to move up, but they're not all going to move up at the exact same time. Okay, so this is understanding sequencing. The very first thing is going to be gold. And gold is always the first to respond. And in fact, gold actually responds ahead of liquidity. Let me show you a chart. So here's a chart on total global liquidity and gold and the correlation. And gold has about a 12-month lead. So the thing to understand about gold is that gold actually trades on the expectation of liquidity entering into the markets, not when liquidity actually enters the markets. This kind of bluish line is a 12-month lead of gold, and then you have the white line, which is liquidity. Very strong correlation there. Okay, so remember, gold is going to respond first and usually ahead, in other words, expectation of liquidity. Then typically tech and crypto are the next ones to follow. And tech and crypto usually are going to trade about 3 to 6 months after gold kicks in. So gold's going to go on a tear, it's going to go up, and then you're going to start to see tech and crypto start to respond from there. Now, next will come things like derivatives and equities. That's going to continue to climb. Then you see real estate. So real estate is always going to be the last one to respond. And real estate is usually between 12 to 24 months in response. And there is a reason behind that. And the reason why real estate tends to lag a lot more is because there's a lot more other factors that slow down its ability to respond to the markets. It is a credit-based asset instead of just a straight-up financial asset. You have banking systems, lending, you have interest rates, mortgage rates, things like that that slow down the speed at which real estate can respond. You also have things like affordability that also factor in. And so a lot of times also, when people build wealth in the markets and stocks and tech and all those things, as they build more wealth, that's also when you start to see more people buying more real estate. So you also have that factor. So there's a lot of factors that push real estate a little further back from the response. And you typically see that about 12 to 24 months. That now brings us to volatility. So now that we know the sequencing of assets, why is it that some assets really move very aggressively and some do not? There actually is reasoning behind that. All volatility is a function of the risk curve. Okay, and the further out the risk curve that you are, the more volatile or the more aggressive asset prices move. Okay, so an example, the S&P 500. The S&P 500 is backed by cash flows, earnings, and all that stuff. It's not very far out the risk curve. And because of that, if liquidity contracts, it's not going to go down as much. When liquidity expands, it also won't go up as much. The closer in that you are on the risk curve, the less sensitive that asset is to liquidity. The further out the risk curve, the more sensitive. And that's why you get other assets like maybe gold or crypto or other things like that tend to have volatile swings. And that's because they're not backed by cash flows. They're not backed by earnings. They're just simply a financial instrument. And there's nothing backing them other than liquidity in the system. And that's why you're going to see a much faster swing, more aggressive ups, more aggressive downs in those markets. But that's not random. It's just how markets and equities and different asset classes work. Volatility is a function of risk curve and liquidity. So I do want to add in one more layer to this, not to belabor this, but I want to talk about ISM and the business cycle, because this is another explanation for how and why we know that the highest probability and by far the most likely probability is more economic growth and increases in asset prices, and that is the ISM. I'm not going to go into much detail about the ISM. It's basically a manufacturing index survey, and it has a pretty good lead on assets. So the ISM is this black line right here, and the way you read it is this 50. So this 50 that you see right here. So 50 means economic neutrality. It means that the economy is not expanding nor contracting. Once you get above 50, then that means that you are in economic expansion. When you get below 50, it means that you're in economic contraction. The higher above 50, the greater the rate. The more below 50, the faster the rate of contraction. So think of this as relative rates. All right. So as you can see, it's very cyclical. It goes up and down over the years. Now, liquidity is a 6-month lead. So in other words, liquidity happens first. As more monies get into the system, that money then goes into businesses. Businesses get more money, they're able to hire more people. And the ISM, the reason this is so important is because this is one of the best indicators for knowing when you're going to have risk assets. So tech, gold, silver, real estate, crypto, all that. That's when you know that the economy is really going to heat up. This is an extremely good indicator for economic either growth or contraction. Recently, over the last couple years, as you can see, we've been in this kind of holding pattern slightly below 50. So we've been in a slight contraction. And many of you, if you own a business, you have felt it. That, hey, it's been tough out there. Cash flows aren't as good. Revenue's not as good. Money seems tight, right? But the good news is that we are beginning to hit above 50. This chart is actually a little old, but we've been hovering right around the 50 mark, working our way back up. Once we get above 50, that is when the economy starts to really kick in. ISM's about 6-month more lag. So once you get that going, that's when you start seeing all these risk assets really taking off from there. So that's another good indicator that economy is really going to boom. And now, so the big question is, so if this liquidity has been going up, obviously it's kind of going up and down some, but if it's been going up, why are we seeing such aggressive pullbacks as of the last few days, last few weeks, maybe last month or two, depending which asset that you're in? Part of that has to do with two main things. We have what's called the TGA, which is the Treasury General Account, mixed in with these reverse repos, this chart here I'm going to show you in a second, and the government shutdown. So remember, as liquidity goes into the system, all assets go up in price. They just happen at different rates. But there is a thing called a Treasury General Account. Think of this like the government's checking account. This is what they spend their money out of. What's been happening has been this buildup of the account. So even though we're getting more liquidity into the system, it's been parked or held back. Think of it like a separate checking account that we could spend from, but we haven't put it into the markets yet. That's been getting built up. And so that buildup has been causing a delay in assets to go up. And in addition to that, you have what's called this reverse repo. So the reverse repo is another tool that the governments can use to either get money into the system, in the markets, or to extract money out. And so if you look at this chart, for instance, in 2021 to 2023, we had some strong quantitative tightening, money tightening. So we've been pulling money out of the markets, and that's because inflation was getting out of control. But it's been slowly coming down, it's working its way down, and it's continued to decrease. So this means that liquidity is getting pumped into the system. So we are pumping money into the system. Some's been held back in the Treasury General account. With the government shutdown, that's also delayed more of this money coming in. So what we can expect is that once the government gets back into play, it's back up and running, that money is going to start getting spent. Things will start to tick up again. So hopefully in the next couple weeks, month or so, you never know the exact time, you just know the general trends, we should start seeing an uptick again. So the last thing I want to cover is, are we in a bubble? I'm not going to go into every asset class. This video's already gotten pretty long, but it's the best thing to do is to talk about the NASDAQ. NASDAQ is tech and is a good correlator. There's a lot of fear from people. Stock prices are crazy. The PE ratios are out of control. Nothing's really making sense for pricing. I can't just keep going up forever. You hear a lot about bubbles bursting. And then especially in tech, you're hearing, oh, it's the dot-com bubble all over again. It's all about to bust. This chart explains that. This is a logarithmic chart of growth in the NASDAQ since the 80s. From here, you can see the dot-com bubble, okay? Right around 2000, the growth went off the charts. It was extremely in a bubble, overpriced. All that bubble burst, as many of you probably know, and possibly some of you suffered from, unfortunately. And it worked its way back down over some time, back around 2008 when we had the subprime crisis and the total global financial reset that kind of restarted the whole way our financial system works. And since then, we follow this band. As you can see, if I can zoom in here, we are really in the mean and average of the logarithmic band. So in terms of general tech industry, which is most of the industries, we're not really in a bubble. We're right where we pretty much need to be. So there's still room. It's not anything like the dot-com bubble. Now, that doesn't mean there aren't going to be certain individual companies that maybe are hype and are in a bubble, but as a general like asset trend or just asset class itself, tech's not really like at a bust cycle. So to relay all this, the big takeaway is everything is based on liquidity. All macro indicators are showing that liquidity is going to need to expand. When liquidity expands, all asset prices rise, but asset prices rise at different timetables. Gold moves first, usually ahead of liquidity. Then about 3 to 6 months when liquidity is really starting to enter the markets, that's when tech and crypto start to take off. Then there's a delay and derivatives and equities and stocks are the ones that start to move. And then about 12 to 24 months later is when you have real estate start to tick off. So based on everything, we should start to see some uptick. I would assume for all of you real estate people out there, I would think that real estate based on timelines, of course it shifts a little bit here and there, you're looking at 2026, 2027. But anyways, it's all the same thing now. It's all part of the same cycle, global liquidity, business cycle. It's all the same. It's just different leading and lagging time frames. So don't be in a panic. Things still look great. Take these dips as favor. Nothing's changed in the trend or liquidity. Liquidity's not changed. None of that, financial conditions have not changed. They all look promising for the forward future, which means that assets should go up. Hope this video was extremely valuable to you and served you well, and I wish you best on everything.